Everyone is asking the same question right now. Is AI a bubble? Half the internet says yes, half says no. And while that fight keeps going, the thing that actually matters is happening somewhere nobody's looking. Because here's what I've noticed studying every major financial crisis for the last 50 years. Every single crash gets a name. .com crash, housing crash, and soon, probably, the AI crash. But the name is never the real cause. The name is just what was holding the money when the music stopped. So what's actually holding the money right now? And more importantly, where is it going next? Let's go back to 1971. Nixon closes the gold window. The dollar is no longer backed by anything physical. And what that means in practice is simple. The US can now print dollars without limit. And because the world trades in dollars, everyone else has to absorb that excess. But excess has to go somewhere. It pools. It inflates. It eventually implodes, and then it moves. In the 1990s, it pooled in tech stocks. Cisco hit a valuation that implied it would need to absorb the entire global tech market twice over to justify the price. Sound familiar? Nvidia recently hit $3 trillion in market cap on $79 billion in revenue. Same ratio, different decade, different label. And when the dot-com crash happened, people called it irrational exuberance. They called it a tech bubble. But nobody called it what it actually was, a dollar excess bubble that had been sitting in tech stocks. Therefore, the dollars didn't disappear, they moved into housing. And we called that a housing bubble, and a subprime crisis, and a mortgage meltdown. Same engine, different vessel, different name. Here's what the capital cycle actually looks like across these three crashes. In late 1990s, companies like Lucent and Nortel were lending their own customers money to buy their equipment and then booking those sales as revenue. Demand looked real, revenue looked real, but it wasn't. The fiber optic cables they built, by 2001, less than 3% of installed fiber was actually carrying data. The other 97% sat in the ground, completely unused. And then watch what happened after the crash. Those cables didn't disappear. They became the physical backbone of Google, Netflix, and AWS. The builders went bankrupt, but the survivors inherited the infrastructure for pennies on the dollar. Therefore, the people who got rich weren't the ones who built it. They were the ones who showed up after. Now, fast forward to 2003. The same dollar excess moves into housing. Wall Street creates instruments, mortgage-backed securities, that make risky debt look like safe investment. And demand looks real. Revenue looks real, but they're not. The crash gets named after the instrument. Therefore, the dollar mechanism underneath, the actual engine, never gets discussed, never gets fixed, and never gets named. Now, look at what's happening today. Microsoft puts $13 billion into OpenAI, and OpenAI spends it on Microsoft Azure servers, and Microsoft books it as cloud revenue. Amazon and Google do structurally identical arrangements with Anthropic. But here's what that actually is. That's Lucent lending customers money to buy Lucent products in 1999. Different company names, same mechanism, same era in the cycle. And the numbers are staggering. The 5 largest U.S. tech companies are now spending more on capital expenditure than their combined operating cash flow. Companies that were built on being asset light and cash heavy are quietly becoming asset heavy and cash light, but nobody is calling it what it is.
Here's what doesn't make the headlines. The dollar's share of global reserves has dropped from roughly 72% in 2000 to around 58% today. And that's not a sudden collapse, but it is a structural drain, slow, consistent, and completely invisible if you're only watching the AI debate. BRICS nations have been settling bilateral trade in local currencies, and Gulf sovereign wealth funds that spent decades recycling petrodollars back into U.S. treasuries are now buying real estate in Asia, infrastructure in Africa, sports clubs in Europe. The capital isn't disappearing, but it is relocating. And the infrastructure being built in the name of AI, data centers, power grids, semiconductor supply chains, is genuinely useful, just like the fiber optic cables were genuinely useful. Therefore, the technology being real is not the argument. The technology was always real. It was real in 1999, too. But the question that never gets asked publicly is who owns it after the crash? Who inherited the fiber? Not the companies who built it, the survivors who showed up after, the people who were watching capital flows while everyone else was watching stock prices. Therefore, the same question applies here. When hyperscalers are forced to pull back on capex, and they will be, when AI startups that never found revenue go to zero, when private credit-backed data centers can't service their debt, those assets don't vanish, they transfer. The question is, to whom? Every era of dollar excess ends the same way. The vessel holding the money gets a name, and the name becomes the story, and the story keeps people focused on the vessel, while the underlying shift, where global capital actually flows next, happens quietly underneath. .com kept people staring at tech stocks, but the housing market was already being loaded. Housing kept people staring at mortgage securities, but the dollar's reserve status was quietly beginning its long structural decline, and now the AI debate is extraordinarily loud, louder than either of those were at this stage. But the things that actually reshape the global financial order don't usually announce themselves loudly. They show up later, in the data, after the fact, visible only to people who were watching capital flows instead of headlines. Therefore, the loudness itself is worth paying attention to, because every time the noise gets this loud around a specific vessel, that's historically when the engine underneath is quietly shifting gears. You now have the lens. Every financial headline from here, read it twice. Once for what they're calling it, but also once for where the capital is actually going. The .com crash wiped the people watching stock tickers. The housing crash wiped the people watching real estate prices. And whatever name gets put on what's coming, the pattern is the same. Therefore, don't be the person watching the vessel again, because the name of the crash was never the point. It never is.